The market just confessed, quietly, not with a press release, not with an announcement, with a number, $26 premium, Shanghai near 130, West near 104. In a normal system, that number gets erased. Arbitrage closes it. Traders buy cheap, sell expensive, pocket the difference. The gap disappears in hours or days. But if it's still here, if it's persisting, if it's widening, the system isn't normal. That's not a spread, that's not volatility, that's a structural fracture. Hello, AG here. Welcome to the Exposure Index. Quick favor before we dive in, hit subscribe. About 78% of viewers aren't subscribed, and this market moves faster than your broker's app can load. You need these updates in real time. Now let's get into what's unfolding, because this is both simple and brutal. Physical is paying up, paper is lagging, and the gap is now big enough to force a reset. Let's look at the numbers exactly as they are on screen right now. Shanghai spot $123.10 per ounce. Shanghai Futures Exchange $130.02. Western spot $104.43. Western Futures $104.63. Premium versus Western Futures plus $25.39. That's plus 24.27%. Quick critical disclaimer. This is educational content, not financial advice. I'm not a bank. I don't manage funds. I don't handle anyone's money. I'm documenting real-time market structure using verifiable numbers so you can think independently. Now pause, that means we're living in two prices. Spot gap, about $18.67. Futures gap, about $25.39. And if you're still thinking, okay, that's just a premium, you haven't understood the implications yet. In a functioning global market, a gap like this dies fast. Because arbitrage is supposed to crush it. Buy in the cheap market, sell in the expensive market. Pocket the difference. The gap closes. That's how markets work. That's how price discovery functions. So if the gap isn't closing, and if it's widening into the mid-20s, it tells you something much darker than bullish. It tells you the bridge between paper and physical is breaking. Because the only reason a $25 arbitrage opportunity stays alive is either the metal at the Western reference price can't be sourced in size, or it can't be moved fast enough, or the risk of completing the arbitrage loop is so high that even $25 isn't free money anymore. And that's exactly what a fracture looks like. Imagine two gas stations across the street from each other. Station A sells gasoline for $104 per barrel. Station B sells gasoline for $130 per barrel. And people are actually paying it. What happens? Everyone lines up at Station A. They try to drain it. They don't debate. They don't check charts. They don't argue on Twitter. They buy because it's cheaper and it's available. And Station A only has two options. It runs dry or it raises price. There is no third option. Right now, COMEX is Station A, Shanghai is Station B, and the line is forming. Here's the part most people don't understand. Spot gaps can happen. They can be messy. They can be regional. There can be logistics issues or local supply constraints that create temporary dislocations. But a futures premium of $25 is different because futures is the market's forward-looking pressure gauge. It's the system saying not only is metal tight now, it's expected to be tighter ahead. The market is pricing in scarcity, not just today, but for months into the future. And the context matters. The one-year average premium for Shanghai futures over Western futures is about $2.36. So we're not talking about a normal premium, we're talking about a premium that is over 10 times the typical average. 10 times. That's not noise. That's not a blip. That's a regime change. This is the killer question. If there's $25 sitting on the table, if it's free money, why isn't every serious trader closing that gap? Why isn't arbitrage working? Because real arbitrage has enemies, 3 of them. Ever tried to buy 1,000,000 ounces of silver at the price you see on the screen? Go ahead, try it. That quoted price, that number from the Western futures market, it's an illusion. The moment you try to buy in size, the price moves against you. Liquidity vanishes. The offer disappears. The actual price you pay is a whole different story. This is enemy number 1 in the silver market, sourcing friction. You can't arbitrage what you can't source in size at the quoted price. Then comes enemy number 2, logistics and time risk. Moving physical metal across oceans isn't like sending an email. It takes time. It requires insurance, compliance, scheduling, and a whole lot of trust. And while your silver is sailing across the sea, prices are moving. Now let's say you buy in New York at 104, expecting to sell in Shanghai at 130. That's a great trade, right? But by the time your shipment arrives, the Shanghai price could be 120 or 140. You just don't know. Your free money trade just became a high-stakes gamble. That's execution risk. Finally, we have enemy number 3, rule risk. This is the big one. The larger that price gap gets, the more likely the powers that be will change the rules of the game. We're talking margin hikes, new position limits, or even forced liquidation. They'll use vague language like maintaining an orderly market. They might even decide to settle contracts in cash instead of delivering the physical metal. When the system is stressed, when too many people demand their metal, the exchanges protect themselves. We've seen it happen before, and we will absolutely see it again. These 3 enemies are why massive price gaps can persist. The arbitrage loop that's supposed to close these gaps is constrained, it's broken. And when that happens, the market starts acting strange. The paper market prints one number while the physical metal routes to a completely different one. The 2 prices diverge. Let me map out exactly how this works, step by step. Because once you see this mechanism in action, you'll understand why the current gap between Shanghai and the West is so dangerous for the paper system. Step 1. Shanghai bids higher for physical metal. They need it for industry, for manufacturing, so they pay a premium. Step 2. This creates a huge arbitrage incentive. Traders see the spread and want to cash in. Step 3. This arbitrage pulls physical metal from the West. Traders start buying up inventory in New York and London to ship to Shanghai. Step 4. This triggers vault drawdowns. As traders take delivery from exchanges like COMEX, the inventory levels start to fall. Step 5. These drawdowns shrink the pool of deliverable metal. There's simply less physical silver available. Step 6. Reduced inventory increases delivery risk. The chances of not getting your metal when you ask for it go up. Step 7. This delivery risk forces buyers to panic. They start thinking, I need to grab it now before it's gone. This forces premiums even higher. Step 8. This panic buying tightens the physical supply even more. It's a self-fulfilling prophecy. Step 9. This brings us back to the start. Shanghai still needs the metal, so they keep bidding higher. Step 10. And the gap stays wide open. The cycle feeds on itself. This isn't just a story, it's a reflexive feedback loop. And markets driven by these loops don't move politely. They gap, they spike, they squeeze. So now we get to the big question, how does this affect COMEX prices in the coming days? The common thinking is that COMEX rises because people feel bullish or because retail investors get excited. That's wrong. COMEX rises when its discount to the physical market becomes unsustainable. A $25 gap isn't just a pattern on a chart, it's a routing signal. It's a giant flashing sign telling physical metal to leave the West and head to Shanghai, where it's valued more. As metal leaves the West, the available supply tightens, making the paper price in London and New York more and more fragile. The system knows this, and it will try to defend itself. You'll see this defense play out in stages. First, you'll see wild volatility, confusing price swings designed to shake you out. Then, margin changes. The exchanges will make it more expensive to hold a position. After that, expect sudden paper smashes. Coordinated selling attacks designed to trigger stop losses and create panic. Eventually, one of 2 things has to happen. Either the West capitulates, and the price snaps upward to match the global reality, or the exchanges change the rules to prevent physical delivery altogether. But here was the trap for them. Smashing the paper price does not create new physical silver. It might push a chart down for a day or 2 and scare some people, but if Shanghai keeps bidding for real metal, a paper smash just widens the gap. It makes the discount bigger and the pull on Western inventory even stronger. Suppression tactics buy time, but they don't solve the fundamental problem. So where do we go from here? There are 3 main paths. Pay close attention to these. Scenario 1 is Western capitulation. COMEX gives in and starts catching up to Shanghai. The price walks up from 104 to 110, 115, 120, closing that gap. If the West has to reprice toward a $130 reality, it will not be a smooth ride. It will be violent. We're talking short squeezes, massive gap ups, and mainstream headlines asking, why is this happening? It will be pure chaos as the system gets very fragile, very fast. Scenario 2 is that the West tries to crush the price on paper. They hike margins, force liquidations, and the media starts pumping out stories about speculative froth. COMEX dips, but here's the key. Shanghai stays bid. Physical demand doesn't care about a temporary dip on a screen. This just widens the gap again, increases the arbitrage pressure, and accelerates the drain on Western vaults. This scenario can delay the inevitable, but in the long run, it only strengthens the case for much higher prices. Scenario 3 is the nightmare scenario for the paper market, a permanent 2-tier system. You'll have screen silver, the price you see on your computer, and delivery silver, the much higher price you actually pay for the physical metal. Once the public realizes the number on the screen is a fantasy, the entire derivative system loses its credibility. When trust goes, liquidity follows, and when liquidity is gone, the system breaks. Now, to answer your direct question, how should COMEX move in the next few days? Honestly, a $25 gap creates immense upward pressure, but the path won't be a straight line up. What you're more likely to see is a pattern of sudden bursts upward as COMEX tries to narrow the gap, followed by brutal paper smashes designed to shake everyone out. Then, if Shanghai keeps bidding, another catch-up rally will begin. So yes, the setup strongly leans toward COMEX being forced higher. But the market will try everything to throw you off on the way there. Remember the old saying, silver goes up like an elevator and down like a guillotine. The moves are violent and the volatility is extreme. This is not a market you trade on emotion. You trade it on structure. Here's your proof-first framework. Watch these two things over the next few days to see which scenario is playing out. First, does the Shanghai premium stay above $20? If that gap persists for days or weeks, the fracture is real and structural. Second, watch the COMEX registered inventory. Is it continuing to decline? If metal keeps leaving the vaults, the pressure is building. This is how you navigate the noise and focus on what truly matters. Does the Shanghai spot price stay double digits above the Western spot price? If it does, the physical urgency is real. The demand is real. The tightness is real. Next, watch the Western dealers. Do their premiums and delivery times change? If you see buy buttons turning gray, if lead times get longer, if dealers start charging higher premiums over the spot price, then the tightness is spreading. It's not just a Shanghai thing anymore, it's global. Also, keep an eye out for interventions in the paper markets. Things like margin hikes, talk about position limits, or official statements about managing volatility or ensuring orderly markets. When exchanges start intervening, it's not because everything is fine, it's because the system is under serious pressure. And finally, the most critical sign, what happens when the paper market gets smashed? If COMEX drops, but Shanghai doesn't follow, if that price gap gets even wider during Western selling, that tells you the paper market is losing its authority. Physical silver is decoupling, and a two-tier system is becoming a reality. You see, Shanghai isn't just a price, it's a message from the industrial heart of the world. Manufacturers there don't buy silver because it is trending on social media, or because a chart looks good. They buy it because their production lines stop without it. We're talking solar panels, electronics, electric vehicle supply chains, and high-end components. Silver is embedded in these critical industries. This industrial demand is inelastic, at least in the short run. Factory managers don't care about the relative strength index or moving averages. What they care about is not missing their delivery deadlines. They care about keeping production lines running. That's why they're willing to pay a premium. Because the cost of not having silver, the cost of a full production shutdown is far, far higher than paying an extra $25 per ounce. Let me give you a specific example of why this matters so much. Imagine a solar panel factory in China. They need a steady flow of silver to maintain production. They have contracts to fulfill, strict delivery schedules, and buyers waiting for those panels. If they run out of silver, the entire production line grinds to a halt. Workers are idle. Expensive equipment sits unused, revenue stops, and contracts get breached. For a manufacturing business, that's catastrophic. So when these factory managers see physical silver getting tight, when they hear about potential export controls, or when they notice longer lead times from their suppliers, they don't wait. They don't try to time the market or check if silver is overbought on some chart. They secure their supply immediately. They pay whatever premium is necessary because the alternative, business interruption, costs them infinitely more than a $25 premium on silver. The exact same logic applies to electronics manufacturers, electric vehicle producers, and any industrial operation that depends on silver as a critical input. These aren't speculators or day traders. These are businesses that need the physical commodity to operate. And when all these businesses start competing for the same limited supply at the same time, premiums explode. This is fundamentally different from speculative demand. Speculators can change their minds. They can sell if the price drops or get scared out of their positions. But industrial demand is locked in. It's structural and ongoing. As long as the factory is running and products are being made, the demand for silver continues, regardless of the price. And here's what makes the current situation so critical. We're not just seeing industrial demand from one sector. We're seeing it from multiple sectors at the same time. Solar installations are accelerating globally due to climate policies. Electric vehicle adoption is ramping up. Electronics demand keeps growing with the expansion of data centers, 5G infrastructure, and AI hardware. All of these require silver. All of these are growing, and all of them are competing for the same constrained supply. This is the key lesson for stackers. When you see the price drop, but no new supply appears, inventories aren't refilling, and physical premiums aren't collapsing, that's often just the paper market unwinding. It's leveraged positions getting liquidated. It's not a sign of weakness in the metal itself or a deterioration in fundamentals. The paper price is an opinion. Physical silver is a constraint. You can print more contracts, but you can't print more metal. Now, I'm going to do what most hype channels won't. I'll give you the bear case, the reasons this premium could be temporary and why COMEX might not catch up. First, the premium could just be a short squeeze or a local bottleneck. It could be a tightness specific to Shanghai that eases when local supply loosens up. We've seen this before in regional markets where premiums spike and then normalize. Second, the paper markets have tools to slow things down. They can use margin hikes and force liquidations to kill momentum, even when the fundamentals are tight. We saw it back in 2011 when silver ran to $49. 5 margin hikes in 8 days, and the rally was over. So yes, exchanges can and will intervene to crush momentum. Third, a major macro risk-off event can smash all commodities in the short term. If there's a stock market crash or liquidity crisis, margin calls will hit and everything gets sold, even assets with strong fundamentals. Silver is not immune to broad market deleveraging. And fourth, profit-taking can cause violent corrections. Traders who bought in at 90 or 100 might decide to lock in their gains. That creates selling pressure and those wild whipsaw moves. So yes, you can see 10 to 20% pullbacks, even in a structurally bullish market. That doesn't invalidate the fracture we're seeing, but it does mean you shouldn't confuse momentum with certainty. Don't assume that just because silver is at 130 in Shanghai today, it'll be at 150 next month. Markets just don't work that way. But here's why, despite those risks, the bull case is scaling up. Because Shanghai's premium isn't happening in a vacuum. Because the direction of inventory levels matters. And because when control over the supply chain tightens, these price spreads don't just politely close. They persist, and they can even widen. If the West tries to suppress the price while Shanghai is willing to pay more, the arbitrage pressure doesn't just disappear. It targets the weak spot. It drains the vaults. And eventually, the vaults either run empty or the price adjusts. You cannot sustain a persistent disconnect like this without consequences. Either metal moves to equalize the price, or the system has to admit that the price was wrong. Those are the only two options. So this brings us to the endgame question. If the premium is $26, it's telling you something brutal. The world is paying to escape the paper market, paying to get physical, paying to secure delivery. The real question isn't whether silver is 104 or 130. The real question is, who has the metal and who only has a promise? Because in a stressed system, the screen can quote any price it wants, but the vault can only deliver what actually exists. Let me be very direct about what this means practically for stackers, for investors, for anyone trying to navigate this market. Keep your eyes on these signals. They tell a story that goes far beyond the daily price fluctuations. Ever notice a huge gap between the price of something on a screen and what it actually costs to buy in real life? That's exactly what's happening in the silver market right now, and it's a massive signal you can't ignore. When you see physical silver trading at a massive premium to the paper price, it's telling you something crucial. The paper price isn't reflecting physical reality. It means if you want actual metal in your hand, you're going to pay a lot more than what the screen says. So if you're waiting for the COMEX price to drop so you can buy cheaper, you might be waiting for a price that simply doesn't exist in the physical market. You could see $104 on your screen, but when you go to buy, dealers are charging $120. That's the disconnect, and that's exactly what the premium in Shanghai is revealing to us. The reference price, the one you see on the news, and the clearing price, what people actually pay, are drifting further and further apart. Once that divergence becomes obvious and persistent, confidence in the paper system starts to crumble. I mean, what's the point of a reference price if it doesn't reference where deals are actually happening? What's the use of a benchmark if nobody can transact at that benchmark? This is the credibility crisis the paper market is facing right now. Let me walk you through what this looks like for the average person. You go to a major online bullion dealer. You see the spot price quoted at, say, $104. You think, great, I can buy silver at that price plus a small fee. But when you actually try to place an order, you run into a few problems. First, many of the most popular products are completely out of stock or on a long back order. Second, the products that are available are priced with huge premiums. A standard silver round that used to cost maybe $3 over the spot price is now $8 over. An American Silver Eagle that used to have a $5 premium now has a $12 premium. So your actual purchase price isn't 104 plus 3. It's 104 plus 8, or even plus 12. You're paying 112 to 116 for physical metal, while the screen is flashing 104. That's a 10 to 12% premium at the retail level. And this retail premium reflects the exact same dynamic we're seeing in the wholesale market in Shanghai. Physical metal is scarce. Demand is way higher than the supply that's immediately available. So the price adjusts accordingly. It has to. Now, imagine you're a larger buyer, not just a retail customer buying a few coins, but an institution, a fund, or a family office trying to buy 5,000 or 10,000 ounces. You can't just click buy on a website. You have to negotiate. You have to find someone who has that much inventory and is willing to sell it. And what you'll find is that the negotiated price for those large quantities is even higher than the retail premium, because finding that much physical silver at once is even harder. This is the physical reality the Shanghai premium is showing us. It's not just speculation. It's not some kind of manipulation. It's basic supply and demand happening when supply is tight and demand is urgent. The paper market can quote whatever number it wants, but that number becomes more and more irrelevant if you can't actually buy anything for that price in any meaningful amount. This is also why it becomes harder and harder to sustain any price manipulation. You can try to smash the paper price down. You can create selling pressure in the futures market. But if physical buyers just step in every single time the price drops, if they drain all the inventory at that lower price, you're just creating a bigger opportunity for others to profit from the difference. You're actually making the problem worse for yourself. The only way manipulation works long-term is if it completely destroys demand, if it scares buyers away so they stop buying. But that's not what happens in a market with a structural deficit, a market where industrial demand is inelastic. Manufacturers have to keep buying no matter the price because they need the material to make their products. And stackers who understand the fundamentals see a paper price smash as a buying opportunity, not a reason to panic. So the more the paper market tries to fight the physical reality, the more it exposes itself, the more it reveals that its price is artificial, and that revelation just accelerates the loss of its credibility. So let me close with what you can actually do with this information. This isn't financial advice, but a framework to think about this. First, track the premium. If it stays above $20 for another week, 2 weeks, or a month, it confirms this is a structural issue. It's not temporary and it's not going away quickly. Second, watch the inventory levels. Look at COMEX registered stocks. Look at the Shanghai warehouse levels. If both are declining, if metal is leaving both systems, it confirms the tightness is real. Third, monitor dealer premiums in your local market. Are the premiums over spot rising? Is availability decreasing? If so, it confirms this tightness is spreading globally. Fourth, prepare for volatility. This market is going to be a wild ride. It will whipsaw. It will shake you out and test your conviction. Don't use leverage. Don't trade based on emotion. And don't try to time every little move. Fifth, understand the endgame. Either the West is forced to reprice silver upward to match physical reality, or we end up with a permanent two-tier system. Either outcome is historically significant and will change how the silver market functions forever. If you've made it this far into the video, you're not a tourist. You're one of my people. So do me a favor and comment below with some real data. What premiums are you seeing where you live? Is it for bars or coins? Are there shipping delays? Any out-of-stock notices? I'm collecting data points from all around the world to track how this physical tightness is spreading. And if you want daily updates on this, make sure you subscribe. I track the premiums, the spreads, the inventory movements, and the rule changes before they ever hit the mainstream headlines. Remember, the metal moves before the headlines. The paper price moves after the margin call. This isn't just another rally, it's a reference reset. And that $26 premium is the system quietly telling you that price discovery is failing where it matters most. The only question is whether you're listening. See you in the next update.